Good afternoon, everyone. We are back. I am back, Sam, with NATP, and I am joined now with Eric Green. Eric is a representation expert and one of our favorite Facebook Live guests we get to speak with every month. Eric has an outstanding amount of knowledge and experience in IRS representation, which is a very critical topic for tax pros, especially always, but especially this year and this tax season. So Eric, thanks for being here today. How are you?
I'm great. How are you?
I'm doing well. Thank you. Busy, but so is everyone. So, we'll just jump right into it. So again, we are recapping. We are here to talk about IRS representation throughout the week. And since last time, we've been getting some questions coming in from tax pros about representation. And so, Eric, you are here with us to answer them today. And if you are watching this and have questions as we go along, feel free to comment below in the video, and Eric might take it on air depending on our time and everything. And so that could be a little fun adventure too, depending on where we go. But first question for you, Eric. This is kind of a multi-step one. So I'll just start with the first one. Can you provide an explanation and the statuses of limitations for, and then there's 4 of them. The first one is assessment statute expiration date, ASED.
Yep. So the assessment statute expiration date is that from when you file the return, the IRS has 3 years to come in, audit, and propose an assessment to that. So, for instance, you are going to file let's say you're filing your client's 2021 returns on April 15th of 2022. The IRS would have 3 years out to April of 2025 to come in and propose any kind of additional assessment against that.
Okay. Second one, refund statute expiration date, RSED.
Yeah, the RSED. Basically, client and taxpayers have 3 years from when they file the return or 2 years from when they make a payment to request a refund. So again, let's say you file the 2021 return on April 15th. That client has 3 years to go and file an amended return to try to claim a refund if they found that they had overstated their tax liability. If they had filed and later on, let's say they're in collection, they make a payment and then they come to you, you're the tax pro expert, and you realize that they don't really owe the money, so you challenge the liability. They have 2 years from the date of the payment to seek a refund of the money they paid. So it's 3 years from the date the return is filed, or if it's later than that, then it's 2 years from the date of payment.
Perfect. Next one, collection statute expiration date, CSED.
Yes, under 6502, the IRS has 10 years to collect the tax, and that 10 years begins on the date of assessment, not the date of filing. So let's say these days, let's say you mailed in the 2015 return. The IRS is taking like a year to process paper these days. So once the paper's processed, the information is input into the IRS system, it will calculate a liability. That is the date of assessment. The IRS has 10 years from that date to collect the tax.
Okay. Last one, audit of returns. They go on to say, timeframe the IRS has to begin, conduct, and complete an audit of a tax return.
It's generally within 3 years of when the return was filed, unless they can show fraud. Then it's 6 years. Now, what's interesting is if they show up and the IRS has less than 1 year left on the statute, on the ASED, they will usually request an extension of the statute. It's a Form 872. They'll request an extension because they need to the IRS. They need to have at least time. They have to have time to do the audit and have at least 1 year left in order to give the taxpayer their appeal rights. By the time they get to appeals and everything else, they don't want to blow the statute. If the taxpayer won't consent to the extension, what they'll usually do is simply issue a notice of deficiency. they won't give you appeal rights. So just issue it. You then have to file in tax court where it will get routed to appeals. But for the audit of the return, it's similar to the ASED. It's 3 years.
Great. And these are pretty common terms, I'm assuming, in the representation.
Yeah, in the tax geek world, we talk CSED, RSED all the time.
Okay, sounds good. And second question. So Eric, you said in the past, the IRS follows the RCP when deciding on offers. This person is doing an offer now that shows the taxpayer's RCP is $1,670 versus the $210,000 they owe. Do you think the IRS will actually accept this?
Yes. All right. So RCP, just for the audience, is reasonable collection potential. It's the formula that the IRS uses to determine what a taxpayer can pay, what they'll accept for an offer. This is, I mean, and it's hard. It's a formula. So this is why when I tell everyone, give me a few hours, I'll show you how to add 100,000 to your bottom line. This is why. So do I think the IRS will accept it? Yes. If you've done the RCP properly, what's going to happen is the IRS is going to come to that conclusion that this is the most they can collect. So long as the offer is at least that amount or more, the IRS should accept it. Now, there are a few kind of out in the fringes exceptions. One is if the IRS believes the acceptance of the offer would actually hurt compliance. And usually that's famous people. So for instance, why couldn't Willie Nelson ever just settle his 14 million or whatever he owed? Because if that got out public that he settled 14 million for like $1.25, how many people are going to say, well, wait a minute, why am I paying my taxes? I mean, Willie Nelson, the guy's famous, right? So famous people, public people in public office, congressmen, those folks, because of the position they hold, the IRS does have an out, and that out is called not in the best interest of the government. But other than that, it's usually for most taxpayers, if you offer more than the RCP shows, and you show that you can't full pay, and it's like $1,700 versus $210,000. I'm pretty sure that taxpayer is showing they can't full pay. I think that offer should be accepted.
Wonderful. So there's the sky's the limit within the equation, of course.
But then you get into the strategy of it, and Sam, this is why I enjoy this so much.
Yeah.
So let's say they did the RCP and it showed $3,000 a month. I'll give you an example. They owe $200,000. They just filed a whole bunch of returns. So they owe $200,000. And the taxpayers show that they have the ability to pay $2,500 a month. Well, times 12 is $30,000 a year. There's the 10-year CSED, which we just talked about before, $360,000. They can full pay. Get into a payment plan. You can't do an offer. But now they come to meet Sam Tax Pro, who's an NATP member and goes through all of our training. And they say, well, wait a minute. Sam says, you don't have health insurance. You're entitled. Go to the exchange and get health insurance. You're self-employed. Go get disability insurance. So now they spend $1,000 a month on health insurance. They spend $300 on disability. So instead of $2,500, they now knock off down. They go down to $1,000. Well, the $1,000, it's $12,000 a year, $120,000 on the CSED. They can't full pay. So their RCP is 12 months of future income, $12,000. So you can take someone who would be a full pay installment agreement and turn them into an offer candidate simply by understanding how RCP works. Fascinating.
That's so interesting.
I know you were up at night wondering how does the voodoo that Eric did? There it is. I just gave away all the secrets.
All right. So another question for you, Eric. You do a podcast, so this one is referencing that. Eric, in the podcast, Steve Just, the Navy SEAL, you said you were default aggressive. What does that mean? Can you explain that a little bit?
All right. So about a month ago, I grew up with two guys who became Navy SEALs. Steve Just and Bob Just, and they're brothers, obviously. And so I had, what I get a lot of is folks, especially this time of year, I'm overwhelmed. I'm supposed to be marketing. I've got my, all my 1040 clients are coming in. I got representation cases. I have kids. I have a husband. Someone I know has coronavirus, or whatever. And what I get a lot of is, how do you not get overwhelmed? And what's interesting is the brothers who I grew up with, when you talk about going through BUDS is basic underwater demolition SEAL training. It's their weeding out. You don't really become a Navy SEAL afterward. It's the incredibly rigorous physical program. In fact, you saw the news, someone just died.
Mm-hmm.
Well, one of the cadets went through Hell Week and just got sick and actually died. It's extreme. It was designed to weed people out. And the rationale is, if you can't cut this on a beach in San Diego, how are you going to do when we're in some hellhole fighting? You can't just wake up one day and say, what, I want to go home now. That's not the way it works. One of the things that Stevie had told me privately years ago was, you keep your world small. In other words, you can get into BUDS, it's 180 days, give or take. And you could say, oh my God, I got to do this again and for 180 days. Or what you do is you just look at it as a sunrise to sunset. I just got to get through this day and get back into bed. Mm-hmm. Don't worry about tomorrow. You can't focus on that. But part of that too is, when it comes to a lot of the exercises and the things that they have them doing, and SEALs, he always said, you are default aggressive, and meaning you want to be on the offense. You want to get up and get after it, because you don't want to stand still. And so I kind of carry that over. Now, what I mean by that, when I say default aggressive, I don't mean weird positions you take on a tax return. That's asking for a fraud referral. No, what I mean is, the way that I run my practice is default aggressive. Now, that could be with the clients. We are on our clients to get us documents. What I would suggest in your 1040 practice, how are you default aggressive? Everyone's got to set up their appointment. They don't set up by April 1st. They're on extension, right? Don't lose sight of the fact that this is your practice. You can do with it what you want. You don't have to work with people just because they happen to call you, right? Fire all your F clients and D clients. When it comes to getting information, if you're going to sit and just react, whenever the client gets around to it, they'll send it, because it's easy to fall into that, right? You're very busy. Do I need to find the time to start chasing people? They're an adult, but here's what's happened. Those are the people that are going to show up on the morning of April 15th, don't want to go on extension, and you got to hurry up and get this done. No. So I think that when I say default aggressive, is you look at what you want to accomplish, what you want your practice to be, what you want your days to look like, and you make that happen. And that means you have to be, I say default aggressive, which is a term I picked up from the SEALs. I'm not a Navy SEAL, but you have to be proactive, not reactive. All right. If you sit and wait, you're going to fall behind. You're going to get buried at the last moment. You have to be pressing people, which, by the way, also sets up for, it's now March, 28th. We haven't received it. We're extending you. So you don't even bother. Come in after, May 1st, because we're not doing anything with it now. And you know why? Because you don't want to work until 1 a.m. You don't want to make yourself sick. It's your practice. If you want to be home at 8 o'clock during the week and have Sundays off, you set your practice up for that. If your practice is so out of control that you're miserable, you did that. You allowed that to happen. So when I talked about it on the podcast with Steve, it was more about get your arms around your practice and make this thing your own.
That's great advice. I mean, you get so caught up in the motions day to day. It's easy to fall into those routines and those traps. And it's a good reminder for everyone that you are your practice owner. You get to make the rules. So
yep.
Here's another one for you, Eric. What is your opinion of the IRS announcement that it will be sending some notices out until they have worked through the backlog of documents mailed? And this is a hot topic. What are your thoughts on this?
So I agree with Congress. It sort of scratches the surface. So what's happening, and we talked about this, I think, last month. What's happening is the IRS, because of short staffing, remote work, they are unable to process paper. So so I'll give you an example, Sam. Somebody will come in who's a non-filer, and they filed the last 6 years of returns, which is what you need to do to be in compliance.
Mm-hmm.
So they come in, they file the last 6 years of returns. 17, 18, 19 are mailed in, or 16, 17, 18 are all mailed in. 19, 20, 21 get e-filed.
Mm-hmm.
The problem is the e-filed returns get processed. Now they move over to collection. No one's processing the paper. So you're calling the IRS. They're telling you you're not in compliance. You can't get an installment agreement. Meanwhile, they're threatening to levy. You can't file an offer because the paper hasn't been processed. Now, last month we talked about what my suggestion is like if you're going to do an offer, I would just include signed copies of all the returns mailed into the offer unit.
Mm-hmm.
They can't deny it. They can't reject it because they're holding signed returns now. But so you can still kind of force the issue. But what's happening is Congress came out and said, you gotta stop. You're threatening people. You're not processing the paper. Mm-hmm. It would be like I go and give my landlord a check, and the landlord says, I'm throwing you out because I don't have the money. Well, I just gave you a check. Yeah, but I don't know if that's going to clear in 3 days. I'm going to throw you out anyway. It's not the way it works. So what the IRS announced is they're going to stop sending some of the threatening notices. And Congress came back the next day and said, yeah, that's not what we're talking about. You got to stop the automated enforcement. So back in June, they flipped the switch, automated enforcement. And Chuck Reddick, our commissioner, is very much on enforcement, law and order. Mm-hmm. In many ways, he's throwing us all a bone, being for former one of us, right? Because we all like enforcement. But they can't be doing that if they can't process what's coming in, because what people are getting, between a rock and a hard place. They've submitted what you asked, but you won't deal with that. And now you're threatening them because you haven't dealt with that. Mm-hmm. And so it becomes this sort of vicious circle. So I applaud the fact that the IRS is going to stop sending some of the notices. I think they've got to turn off the automated enforcement until they can get through the backlog. Mm-hmm. And that backlog is, I think, 6.8 million unprocessed returns.
At least, yeah.
That's not even the 2022 season.
Yeah.
So it's a nightmare.
It's a huge problem, and a lot of taxpayers are angry, rightfully so. They're getting these notices that don't match up, and tax professionals are getting those questions and directed at that anger. It's a huge issue. Right. Absolutely. Another question for you, Eric. Can you explain what happens with innocent spouse relief? This is a two-parter. So that's the first part. Second part, can my client get a refund of the monies taken because of husband's liability?
So they're kind of tied together. So what happens with innocent spouse? So there are three types of innocent spouse relief under Code Section 6015. B, C, and F. B, and by the way, we did a program on this. It's on demand in the NATP Learning Center. You can go watch. Under B, the couple doesn't have to be divorced. The spouse just has to show that they aren't responsible, didn't benefit from it, had no reason to know. And so what happens there is if they get relief, the tax liability gets apportioned. So if you imagine, let's say husband, actually, let's reverse it. Let's be more woke. So the wife is making $500,000 a year, and the husband makes $50,000 a year, and he gets innocent spouse relief because she never paid her estimated taxes, all that. I'll make her the bad guy, bad lady. Anyway, so what happens is they would give him relief. So let's say the tax liability is $250,000. What they'd say is, well, he only brings in 10%. He would be on the hook for 10%. Well, that's still $25,000. His tax bill really may have been $5,000. Now it's better than the $250, mm-hmm. but it doesn't necessarily get him off the hook because of this apportionment. So the reason I mentioned the three types, B and F, which is equitable relief, there's an apportionment. So you may or may not get full relief. But there are refunds. If you can do this within 3 years and get the relief within 3 years, and let's say the client was being levied and now they actually can get a refund for under section 6015B and 6015F, there you can get a refund. Now 6015C, they have to be divorced or they have to be legally separated for at least 12 months. They're treated as if they were married filing separate. So there's no apportionment of the liability. So in our case, husband would be off the hook completely from bad wife's not paying the tax. However, there are no refunds under 6015C. So what I have found just in my practice over about 20 years, more than that, 22, 6015C is really the best place to be for relief. I've never had a client ever be entitled to a refund. All right. It's just the way that because of the different income tax brackets, that apportionment, B&F would work great is if both spouses made exactly the same. Okay. Because they'd be in the same bracket and it would just, the apportionment, the allocation of that would kind of work out to, as long as they had normal withholding done, they should be fine. Usually they're not. One is much higher than the other. So even though in this case, our husband gets relief, and I've had this where we went from 400,000 down to 27. She had 10 of withholding. She still owed 17. And I remember her turning around saying, well, I thought I was going to get relief. Well, you did. And of course, I explained this to the clients. We now add it into our retainer agreements because they never remember that. They said, well, you said I'd have relief. You didn't get relief. You don't owe 400. You only owe 17. So that's the one thing about innocent spouse is that winning your innocent spouse case doesn't necessarily mean you're completely off the hook. It's usually much better. But 6015C, you're generally off the hook. But if you are in one of those situations where you've been getting levied year after year, this has gone on a long time, you can't get a refund upon getting relief.
Interesting. We did have a question come through in the comments from Yvette. We'll read that. How does a medical debt come into play in an offer? Taxes are old, medical debt is recent, but huge.
Well, so here's the interesting thing. The medical debt is after the IRS debt. So it would be viewed as, unsecured personal debt. Now, if the medical institution, let's say it's a hospital bill, if they were to sue and get a judgment, and now you're paying on the judgment, that would be a secured debt payment. But what normally happens, Yvette, what I'll do, so let's say the client comes in, and this gets into the strategy. And so actually, I'll give everyone sort of, we do an offer workshop every summer at Tax Rep. We start talking about strategy. So I remember I told you that they owe 200, but they can pay 2,500 a month, 30,000 a year, they can full pay. I told you about health insurance, disability. That's going and incurring expenses that are allowed to reduce it. But one of the things that you normally start with is there anything obvious and easy? Student loan debt. Well, it's in deferment. Call them, set up the payment, and start making the payments. And we can even set up that payment in a way designed to get you to the RCP number. If you have medical debt, and let's say they're not paying, if they call up the institutions, get a written agreement to pay so much per month and start doing it, medical expenses are allowed. Now, if you're not paying it, what the IRS is going to say is, yeah, but you're not paying it. We're not going to allow it if you're not paying it. So start paying it, right? So child support, people that have not paid child support. Well, first of all, pay your child support, you deadbeat. But aside from that, I had a client once, I actually said that. And I'm like, why don't you pay your child support? I'm like, well, you can pay the government, but I'd pay your child support because I got news for you. She's going to go to court and you're going to pay the child support anyway. But I said, aside from that, just pay, why didn't you pay your child support? And he looked at me and he's like, I guess I should, huh? I'm like, yeah, probably. And so, so it's an obvious one. So Yvette, that the medical debt, first of all, it's dischargeable in bankruptcy. It's behind the IRS in time. So you're going to find the IRS is not going to factor that in. What you can do though is have the client start dealing with it. Like again, if let's say they can show they pay $2,500 a month and they owe $30,000 in medical debt, and I tell the client, look, at 50, let's say the 200,000 divided by the 10 years, right, is 20,000 divided by 12 months. It's like 16,800, something like $1,680 a month. Why don't we set up for you to pay the medical debt $1,000 a month? Why? That goes from 2,500 to 1,500, and 1,000 is going to take 30 months. The offer will be done 12 to 15 months, and we'll still have it there. So you don't want to pay it too quickly because then it's gone by the time they accept it, and they don't count it anymore. Right. And why don't we use the medical debt to get rid of the IRS? So now at $1,500 a month, they can't full pay, $18,000 offer. We just paid the medical debt, and in doing that, managed to get rid of $182,000 of tax debt.
Wow. Yeah.
That's the kind of thing that's why I enjoy this work. That's the kind of thing with the formula where once you kind of get your arms around it, first of all, we get on average, I think the average fees are around $8,000 for an offer. What do you need? One a month to add $100,000 to your bottom line? I find it fascinating. I find the strategy, it's very interesting. Every case is different. You've got, it's $1 million, massive heart attack. Ooh. Oh,
yikes.
But I mean, well, again, at $1 million, again, from the IRS's perspective, you can go bankrupt on it. Go bankrupt and get rid of them. And remember, Yvette, Code Section 6321 says, upon demand for payment, if payment is not forthcoming, a lien arises retroactive back to the date of assessment. Even if they don't file the notice of federal tax lien, a statutory lien is there. So the IRS's argument will be, we're ahead of them, they're unsecured, take a hike. Now, the two ways we can do this is A, the medical, whoever's owed that money, their attorney gets a judgment. Now you can start paying on the judgment. That becomes a secured debt. The IRS has to allow it. The alternative is they just call up and say, look, I know it's $1 million. I can't really pay. Would you accept $1,000 a month? I'm going to stick it to the government. And we set up the payment plan. And as long as you can show they're paying it. And two, they have a written agreement. So the institution says, okay, we understand you can only pay $1,000. We'll accept $1,000 and we'll revisit this in, 24 months. You now have something to hang your hat on. Hey, we got this payment plan, medical expenses, they're allowed, and do it that way. And once the IRS is gone, then honestly, they can go to bankruptcy and get rid of the medical bill.
That is fascinating. There's a lot that goes into this. You can tell as you're speaking, but
it's the strategy, and it becomes more of a problem when it's family.
Okay.
Because, in fact, I did a podcast called "Why Every Parent Should File a Lien Against Their Child," and the rationale is, mom and dad are lending money, do a note and file the UCC. And of course, what you get back is, but we trust little Johnny. It's not about trust. One, you protected your investment, and two, they now have a friendly creditor between them and everyone else. IRS for income tax, sales tax with the state, withholding tax, a judgment. God forbid, they hit someone with the concrete truck and now they're getting sued. It's called a secured party sale. The creditor just forecloses. They take the assets and they wipe out everyone else behind them. Now, there'll still be an individual that owes individually, but we can do an offer and compromise and get rid of that. So anyway, it's Yvette, thank you. Good question.
I want to wrap up, Eric, here with one last question. And so going back to the IRS halting some collection notices, why is it now? Is it a good reason to consider getting into representation? And how can Tax Rep Network help?
So two things. One, if you have clients that owe money, with them backing off, this is your opportunity to work on this and get this resolved. When you're under the gun, I will tell you, I'm much happier when non-filers come in. We can get the returns on, and now every strategy is open to me. Married filing joint, married filing separate. Do I file the state return, get a payment plan with the state first, then file the federal? Now I can use the state to get rid of the feds in that same sort of an RCP. All of that is open. The plethora of fun things is all open to Eric. The moment they show up, they're now being levied, and they can't pay their bills. Worse, they're going to have trouble paying me. Let's focus on what's important. Because now you're reacting, right? Now you're under the gun. That is not as much fun as it is when we get to sit around the conference table here and talk about, what about this? And it's like moving puzzle pieces around, or if you ever played Risk, like moving pieces on the board, like on the battlefield, where you get to really strategize. So to me, the breathing room, here's what's going to happen. There's some taxpayers are going to be like, oh, great, they're leaving me alone. I can vanish again for another 6 months until they're hounding me. And there's nothing you can do about those people. But they're there's almost 50 million people in trouble, non-filers and people that owe balances. Now is a great time, especially when you have all your clients in. The biggest thing right now this time of year is to make sure that your clients know that you do this. Because my first tax rep member, Anthony DeLucia, after he went through the initial training, sent out a one-page letter to his, I think it's like 450 1040 clients, what to do if you can't pay the taxes. And he said he got 145,000 of work from that one letter. And that letter is posted inside the tax rep members in the marketing area. Basically, what he got was a lot of people calling saying, I didn't know you do this. My son hasn't paid his sales tax. I haven't filed in 3 years. My brother owes money. Like nobody knew that he did this. And what I think it really stands for is during tax season, while you have your warm audience, this is a great time to send them something. Listen, if you can't pay the taxes, we can do an offer. We can do an installment agreement. You might be uncollectible. If you think that you don't owe the money, we can challenge that. Make sure you talk to us about it. And what it does is it lets them know, hey, I didn't realize, I'll pick on Yvette. Yvette does this. I've been kind of hiding the fact I haven't paid my people on the books. They're all been off the books. Can I clean this up? And people will start, and by the way, referring people to you, but that can't happen if they don't know you do this. So the government giving us breathing room is a great time to try to get clients in, figure out what to do when you're not under the gun, and do that. But during tax season, when we're all so busy, you're like, yeah, right, like I have time to start doing offers. Make sure you get the word out to your clients that you do this, because May is a great time when the government gets its act together and starts hammering people again. Offers 5,000 a piece, 5,000 a piece. You guys getting a few of those a month. You'll decide probably next year, why am I doing 1040s?
That's fast. That's great advice too. Again, with the warm audience, you've got them there already. Why not try and upsell a little bit?
Your audience is coming through your office, or at least sending you their stuff, and they're actually reading your mail.
Right. Wonderful. Well, that's all that I've got for you, Eric, unless you had anything else you wanted to add.
Somebody had sent me a message, which didn't make it in. Am I going to be at the NATP Expo in Vegas? I am. We are talking to the commissioner for exam, DeLon Harris. Either he or his assistant will be there. So we're going to be doing a whole program on audit. And you'll get to hear from the government, the executives of the government, what they think is going on from audits and what we should expect going through 22 and into 23. When all these 2021 audit returns start getting audited, what are they focusing on? What's their priority? I'm very excited to be back in person in Caesars in Vegas.
Yeah,
popular place.
Exactly. I know we're all really excited to be back in person, I think, and back together again. So exciting news coming. Thanks again, Eric, for joining me today. I really appreciate it. Thanks, Yvette, for asking those questions live. It was great to see that interaction. If anyone has any questions following this, feel free to email us, send us a message. However you can get a hold of us, we are here and ready for your questions for next month. Eric's going to be joining us again in March, so we will see you then. But until then, have a great day. Bye, everyone.